Let me tell you a fun fact. Within the last 2 centuries, more than 90% of the world's millionaires have been created by investing in real estate. But if done incorrectly, without the right knowledge, required skills, or partners, it can also create a ton of problems and a lot of sleepless nights. You feel like sometimes there are way too many gurus out there trying to sell you on a weekend course or just too much noise to cut right to the facts? Yup, we did too, and this is why we started this podcast. Our goal is to provide real estate investors, entrepreneurs, and enthusiasts with all of the most recent knowledge, secrets, tips, tricks, and tactics so that you can grow your own portfolios, increase your returns, net worth, and most importantly, create generational wealth for you and your loved ones. Remember, this is your real estate career. Information is your sword and shield, so eat hearty, prepare for battle, and grind your way to victory. My name is Tejas Gosai. I'm joined by my partner, Jeremy Moyer, and we welcome you to the Real Estate Investor MBA podcast. Hey guys, welcome back to your favorite real estate podcast. It's Real Estate Investor MBA. I'm your host, Tejas Gosai. My partner, Jeremy, couldn't make it today. He will be missed, but we are going to be talking about something that I love truly, dearly, cap rates, capitalization rates. This is the metric that every investor, from starting out with your first 4-unit or multifamily up to folks that own hundreds of millions in real estate. This cap rate is the crystal ball, as I will try to explain to you, on how you can really figure out what will happen with your investment over time. This is all about mitigating risk and making sure that we understand the property and the facts to have an educated risk with your investment, right? You want to take the limited risk and you want to make sure it's the best investment. And so the cap rate, the minutia of it is very important. So, to all the folks that have been asking or emailing us, let's hope this is a good explanation. So what is a cap rate? The cap rate is calculated by dividing the property's net operating income, which is specific. It's not income, it's the net operating income, by the current market value, or your purchase price. This ratio, expressed as a percentage, is an estimation of an investor's potential return on a real estate investment. The cap rate is most useful as a comparison of the relative value of similar real estate investments. Okay, kind of simple here, but let's go to the more challenging stuff. So understanding the cap rate. The cap rate is the most popular measure through which real estate investments are assessed for their profitability and return potential. The cap rate simply represents the yield of a property over a 1-year time horizon, assuming the property is purchased on cash and not on a loan. The capitalization rate indicates the property's intrinsic, natural, and unleveraged rate of return, which is super important because you want to leverage your money, but right now cap rate is not taking that into account. So here's a question that we always deal with as commercial real estate agents. Why would I purchase this property with such a low cap rate? And there are reasons to purchase a property at a low cap rate. I'll explain that. So one is potential. So there are properties in California that are 2 or 3 bedrooms that are selling for $1 million. There's the same exact structure sold in the Midwest for $100,000. So appreciation is key, the potential of what the investor sees or analyzes. Value add, huge importance in real estate. So you might be looking for a place that has lower rents, and you're going to use your property management company and team to raise the rents over time with some improvements that might not be that major. Maybe they just need a good landlord, and that can up your cap rate. Leveraging your debt is very important. So right now we're not going to deal with that, but you need to take that into account. You will most likely be purchasing, well, if it's a 5-unit plus or a commercial property, it's with 25% down, typically 75% loan to value. but we'll deal with that in another podcast. So net operating income means the operating income. I'm going to show you the calculation that has to take into account a bunch of different factors like property management, vacancy, maintenance and repair, things like that are taken from the rental income. And what's really, really important is data. You have to be a nerd about this. You want to use the internet as your best friend when you're targeting a property. You have to look at comps, and you can't, as a commercial real estate agent, you can't believe everything you read. Projections are anyone's best guess. If you're a reputable listing agent, you want to make sure you base everything on comps and that you're looking at Rent-A-Meter or doing your own analysis on what the potential rents could be. But that's not always the case. And it's customary to share pro forma numbers to attract investors, and the actual numbers are much lower. You don't have to be afraid of that. If you have a good property management company, or if the property is just in a fantastic location, it's, let's say, an owner that is retiring and you just happen to catch this property at the right time, it may make a lot of sense. Let's keep going. So the analysis, the data part of this, comps, you can ask your realtor to come up with comps when you're looking at properties on the purchase side. You want to really look at rental comps as an investor. Most folks that listen to this podcast own multifamilies or want to own them. And, looking at Zillow even and all the other hot pads, websites to see what condition the properties are in. You can gain a lot from looking at the images and spending half an hour. And then Google Images too. You can go back in time and see the property. Google did the work for you. Maybe there's some new development that took place, things like that. You really want to look at the businesses in the area. That will tell you the growth, right? That's what we're here for. There's also a lot of public information that you can find with patterns of economic development and different companies. Like in the Lehigh Valley, for example, we have Prologix has like hundreds and millions, I think, of square feet in warehouse space here in the Lehigh Valley. We're a huge transitory passage to New York City, Connecticut, Boston, New Jersey. So Lehigh Valley in the eastern side of Pennsylvania, like Amazon, Nike just got 1 million square feet out here. That's big for local development. A lot of those companies and warehouses need employees, and they're very sustainable jobs, and they need rental. Well, I shouldn't say that. They need suitable housing. We're not talking about slumlords here. You want to be a good owner, a good landlord. And that's where some of your value is too. Treat your tenant right. They're going to have less turnover. That's a big part of what you want to look at in keeping somebody. It might be better to have a little bit of a lower rent and have a good relationship with a good tenant that you scouted. So commercial development, it's very easy to hear towns and cities brag about themselves. That information is easily ascertained. Also, some simple Google searching will tell you a lot. And then one huge thing before we get into the numbers here is your personal assets matter a lot when you are analyzing for cap rates. So, location, condition, CapEx, capital expenditures, looking at replacing a roof over time, that's a large expense. These are things that you want to factor in. And if you don't factor these in, you will deplete or totally negate all of your profits when you took over the property. That's how serious a roof could be on a 4-unit, even a 2-unit. So when you look at these properties, you want to have a reputable inspector as one of your teammates. Everyone talks about in real estate, build your team. Well, realtor will help you find a good inspector, bank, all of those things that we've talked about in other podcasts, but you are specific to your cap rates that you run. They're very malleable. You may have a best friend that's a contractor. You may be a contractor, and your cap rates for acquisition are significantly different than somebody else who's a doctor who cannot put that type of time and energy and knowledge into a property. So you want to find out your best assets. Now, it's been about 10 minutes, and I'm trying to talk quickly and keep the points as detailed as possible. Before we jump into the numbers, I am a numbers guy through and through. I think that has been why people rely on me and my judgment on how to invest in real estate. I am my own worst enemy. I will spend more time than anybody else on looking at the numbers, analyzing them, walking the streets, knocking on the neighbors' doors to test if it's a good neighborhood, staying there until, scouting until 1 a.m. just to see what kind of foot traffic there is. If it's a mixed use property, what kind of folks are coming in and out, what's the hours. There's so many things that go into this that aren't in the numbers. The numbers are what we use to even go near a property, right? So if you're an investor, you're going to look at these listings, you're going to consider purchasing them. You may move really quickly if it matches your numbers. So this is not the best pro forma, but I wanted to have a real world example. And these are a lot of the things you'll need to look out for. So let me pull this up real quick. Okay, guys, look at this beautiful 5-unit. It does not exist. If it did, I wouldn't be sharing it, be purchasing this property. But what I'm going to show you here is how you can value add your way into turning a 5-unit property for $500,000 into a 5-unit property worth $1 million. Now, a lot of this is variable, but let's start with the basics. All right. We have a 5-unit here. It's in a great location, decent condition. We've talked to the owner. We want to make an offer. It's $1,000 per unit per month. So for 5 units, it's $5,000 for the month. That's the gross income. So that gross income times 12 is $60,000 for the year. We still got simple math here. So I'm going to jump ahead. The net income for this property, which is what you use in your cap rate, is $50,000. The difference between the gross and the net are the operating expenses that we're using. So operating expenses are your taxes. We have $1,000 here. Insurance, another $1,000. Your water and sewer bill, we put $500 in this example. Property management, we used 5% of the gross. That's $3,000 for the year. That is very important. Let's stick here for a second. Property management is the make or break on whether or not you will be successful in the long run for this business. Anyone can run a property into the ground. You could be buying it at a 10% cap rate, and without the right property management, your tenants are upset, your maintenance isn't done right, your drains need to be snaked all the time. You might have cast plumbing. So there's a lot of different things that goes into this. Property managers keep your tenants happy and they make sure that complaints are dealt with. You want to pay your property managers well. 5% is probably not what you're going to pay, but I use this as an example. It's most likely going to be 10%, and you pay for what you get. So make sure you know who your property manager is and don't worry about the percentage as much as you want to worry about preserving your asset so that you can purchase your next property. Managing your own properties is fruitful to a certain point. If you want to scale up, you have to find a good asset manager. We have a couple great podcasts specifically dedicated to just asset management. All right. So now next line here, vacancy, super important. You got to think about whether or not you're going to have a vacancy, and typically 10% makes sense. I put 5% here, but vacancy could really hurt you if you're in a mixed use. Let's say you have a commercial, you have a 4-unit, there's 3 residential units up top and a commercial on the bottom. Let's just say it's a pizza shop. If that pizza shop goes out of business, you may not refill that tenancy for a year, maybe 2 years, depending upon the location, also the condition. So you really want to make sure that these things are factored into your analysis. And again, I would suggest using higher numbers. 10% for property management, stick to 5% for vacancy, assuming that you're buying properties in a good location. The worse the location is, you should definitely raise the vacancy number. On our property, on our example here, this 5-unit, we have oil as the heat. So there's a boiler that heats these 5 apartments. Why is that really important? And why would I force us to talk about this? This is a perfect value add. So if the owner is paying $500 for the heat, and the tenants I have here, it might be a little bit more, but tenants are keeping the heat up. What you could do is convert the boiler to basically shut it off and put electric baseboard heat into all the units. Energy efficient. They really are a reasonable price and they perform very well. We use them in most of our apartment buildings. But this is a perfect example. You take off the $500 charge on paying for the oil, and the tenants get energy efficient heating units, and they also will be paying that themselves, right? So electric, I have an owner's meter here. It's a little bit high. I'm trying to round out to 10,000. And then we have 500 for maintenance and repair. Total expenses on the operating side is $10,000 here. So let's recap. 5 units, $1,000 actual for each unit. That's 5,000 a month. 12 months in a year, that's 60 grand. All those expenses equal 10,000. Now we have a net income of 50,000, and you are purchasing this property for $500,000. That net income of 50,000 is divided by 500,000 to equal a 10% return. And that is a really good return. It is rare to find a 10% return in a good location with good condition. The Class A assets have significantly lower cap rates. There's Class A location, Class A condition, Class A tenancy. There's so many different ways to look at it. But with our example here, we have a 10% cap rate. We are going to the bank. We would actually never sell this property. Now let's make it better. Let's turn it into $1 million property. So all we're going to do is we're going to spend a little bit of money. Let's just factor in a negligible number of 20,000. Now, what that 20,000 is going to do is get us an extra 500 per unit per month in rent, right? So from $1,000 a unit to $1,500 a unit for each of them. So that goes from 5,000 a month to 7,500 a month. Now, we'll keep all of our expenses the same. So that 7,500 a month times 12 to get our yearly gross is 90,000. If we can keep it at 10,000 on the expenses, we have our gross rents per year at 90,000 minus the operating expenses of 10,000. That equals 80,000 to the net income. Now, if you were to sell this, and I hope you're still with me, just that $500 bump up in rent, if you sold that property at an 8% cap rate, lower than what you purchased it for, because you added value and you put a bunch of work into it, and you worked with your asset manager to get nice tenants with clear background checks and high credit scores to pay $1,500 a month per unit. And that would be $1 million valuation. Let's do that again real quick. So originally we had $1,000 rents, then we're at $1,500 rents. That took our gross up $2,500 a month. That takes our gross to 90,000 minus the 10,000 on the operating expenses. So if we sell this at an 8% cap rate, net income 80,000, right? Divided by $1 million purchase price is 8%. We started out with a 10% purchase at 500,000. After a year or two, we sell it at $1 million at an 8% cap rate because someone else would be willing to purchase it at that time at a lower cap rate. Why? Because you picked a property in a good location that was in a good condition, that you made into a better condition. You watched the economic development. The area was rising. Your tenants all have 1-year leases. There's no pets, no smoking. The place shows beautifully. All of your accounting is in line. Everything is tracked. And so, having the best media company presenting that whole thing, you could sell that property at an 8 cap and a buyer would pay that all day. And you would turn that property from $500,000 to $1 million. That is called creating equity, right? Your value add. This is how you do it. So I have gone on, and sometimes I just get lost in this, but I hope this makes sense. And I hope that you have an analysis template for this. I give all of my clients a simplified version of this, except it takes into account your financing so that you can leverage your cash, which changes your total ROI. Because I have to wrap this up, people advertise cap rates. I advertise cap rates. All commercial real estate agents do this. 90% of them do not take the right information into account. For example, hey, there's a 4-unit, it's a 12% cap rate, but the listing agent did not include the taxes, the insurance is estimated, the water sewer is actually significantly higher, which matters if it's a 4-unit. You don't have enough units to spread that type of a an adjustment. So data. You guys really got to have fun doing this. So I hope I've shed some light on the beautiful cap rate unicorn process, right? You're always looking for a unicorn. It's really tough to make sure that your criteria in the market you're looking for meets your cap rate. We call it a hard cap rate, right? Because if you can factor in property management at 10%, or say 8%, you have a contract, you know your vacancy, or you know that you're going to have less vacancy because there's such a demand in that location. All those things matter, and it will also help you evaluate your property for the future. Please check out our other podcasts, and please give me a call or shoot me an email if you would like a pro forma. We have one available on our website, www.rei.mba. We just had our website redesigned. Take a look. And yeah, cheers. Happy hunting. It's Tejas Gosai, Real Estate Investor MBA. Yours truly. Cheers. Take care.